Okay, so thank you very much, Anka. That was a great presentation. So the next presentation is going to be by me. So I'm Brad, I'm the speaker, and I'm with Upside Options, and I'm going to talk about how to generate monthly income using credit spreads and iron condors using the S&P 500 index. So if you have any questions, go ahead and send them, and I'll be watching for questions. And okay, let me jump in. Okay, so how to generate monthly income using credit spreads and iron condors. And this is, I believe, is an optimum strategy for today's volatile market, and it generates about 2.5% to 5% per month. So what I will address in this presentation are the following. How do the major charts look and what are they telling us? How's the economic data looking? Where is this market going next? How's the Federal Reserve impacting the markets? And then I'll review Pinnacle. That's the strategy that's it's a conservative, non-directional, income-generating, all-weather credit spread and iron condor strategy. And we call it Pinnacle. So, and I'll review a recent trade that we opened in Pinnacle, and then we'll look at the risk-reward graph for the trade. So I have 3 slides on Upside Options, and then I'll just dig into you know, the guts of this presentation. You know, I'm just glancing right now just at the questions pane. Just want to make sure that everything looks good. Okay. So the strategies that we have available are the following. We offer a non-directional income strategy, and that's what I'm going to talk about today. That's Pinnacle. And then we have long-short quantamental strategies. And quantamental is a blend of technical, fundamental, and quantitative analysis. So we have a big cap growth, focuses on big caps greater than 10 billion. We have a small and mid cap growth that focuses on the 250 million to 10 billion. We have a contrarian strategy, focusing on stocks that have been out of favor for 6 to 12 months, and they're starting to recover. We have a sector rotation strategy that concentrates on the strongest stocks within the strongest industry sectors, and then I'll be talking about that one later today. I have a presentation on that one. And that one's up about 10% year to date. And then we have an iron condor Pinnacle strategy. That's what I will talk about now with this presentation. It's a non-directional, income-generating, conservative, all-weather strategy. We're writing credit spreads, iron condors, primarily on the S&P 500 index. Generates 2.5% to 5% per month for most months of the year. And it's up 20.3% year to date. And we have free trials available at upsideoptions.net/free-trial. Our differentiation. We have a 4-level quantamental analysis scanner. So it's blending technical fundamentals and factor-based quantitative analysis. Our portfolios are hedged. And we plan to open and manage more hedges in the next month or two. And what they do is, well, I'll talk more about how we do these hedges. And it's unique, and we can actually keep the cost low to maintain the hedges. We follow strict exit rules. We can let the winners run, but our exit rules are fast enough where we can lock in gains to protect capital. So for example, in October 2008, our portfolios went from 75% allocated down to 15% allocated in about 6 days. I couldn't tell you that a correction was coming. All I could tell you was a lot of our stocks were getting stopped out every day for 6 straight days. And we just followed the rules. And so we went down to about 15% allocated. And then once October 10th hit, then the market really started tanking. And then, of course, it went even lower prior to Christmas Eve. So we finished off 2018 with some solid gains, with our portfolios plus 18 to plus 25% gains, where the benchmarks all closed down -8 to -12% for the year. So that's because we follow strict exit rules, and that was the primary. At that time, we did not have the hedges open, so the only reason I can show these gains is that we follow strict exit rules. Okay, our differentiation. Here's an overview of our 4-level quantamental scanner. So step one is a macro analysis, big picture. Do technical, breadth, fundamental. And when I say technical at the macro level, we're usually looking at the indexes and then the ETFs, big picture. What's the market doing? Is it healthy? Is it unhealthy? Breadth, for example, advanced decline line, usually a cumulative advanced decline line along with number of stocks over the 50-day line, things like that. Fundamentals, how good is the company doing? Sentiment, investor sentiment, that's overall sentiment of the market. And then you pull all that together and that modulates our bullish and bearish exposure levels. Then we do a technical scan. We're trying to find high probability setups. And there's about 4 different setups that we like. And the one that I'm going to show you today is a simple one. It's the breakout. It's purely the breakout. Then we do a fundamental screen. We're looking for strong or weak companies, strong companies for the bullish trades, weak companies for the bearish trades. Then we do a quantitative screen. That's more of a probabilistic kind of metric type of system. It's basically using linear regression analysis, and it creates a big grid of probabilities. And I'll show you what the output looks like. And then we use technicals to trigger entries and exits. Okay, so that's it on who we are. Let me go ahead and just dig into the presentation of starting with big picture of the current market. So where are we? So we're a slightly expensive market trading at about 17.2 times forward S&P 500 earnings. And right now I'm showing earnings at about $173, and I know that that's all over the place. Everyone seems to have a different number. I usually use FactSet, FACTSET. You can type them into Google, and there's a free report that comes up, and it's very robust on their earnings. I know one house actually just knocked earnings down to $166. But so I use about $173 of earnings for the forward S&P 500 earnings. The U.S. economy has been slowing. Global economies have been slowing at a faster rate. Corporate earnings have slowed. We have flat growth for Q1. We're pretty much going to have flat growth for Q2. And I kind of saw again from a couple analysts that they believe we're going to have flat growth for Q3. Corporate earnings ultimately drive stock prices. That's what drives the stock market over the long run. Headwind, that will keep the SPX below its all-time high. All-time high right now is 30.26. Newest tariffs on China on the final $300 billion in trade. That's not good. That's what brought the market down 6% just recently. We have continuous political uncertainty that can sell off stocks at any time. Negative surprises on the economic data. So I watched the Citibank Economic Surprise Index, and it's been rolling over for literally 12 months. A yield curve that is flat and was inverted. And the bond market, meaning the bond market still projects a slowing U.S. economy in 2019. Tailwind that puts a floor under the market, and it could push the market higher. So we have a dovish Fed now. Lowering interest rates is needed. Recent jobs report was good. So we have a very tight, full employment jobs market right now. Low interest rates and low inflation, so that's good for stocks. Consumer still strong. That represents 70% of the economy. When we say the consumer, we talk about consumer spending. That represents a huge chunk of the U.S. economy. Most analysts are projecting 1.7% or greater GDP growth for 2019. That's fine. I mean, the economy is still growing. Going into a recession is a gradual process. It's not an event. It takes many quarters to unfold. And when one eventually hits, and we will have a next recession, when's it going to hit? Probably not until now, late 2020. And if it hits, and when it hits, it will cut the stock market by minus 30 to minus 50%. We'll be in a bear market for about a year. That's usually what happens. Overall, the market has been pretty volatile. It's been difficult to generate consistent positive gains using stocks, ETFs, or indexes. Okay, let's look at the charts. Here's the S&P 500 index. And this was back in 2015-16. This was really ugly market. This was a lower low here. Market was basically telling us we're going into a recession. We're getting high probabilities or higher probabilities. Trump got elected, market took off in anticipation of tax cuts, deregulation, infrastructure building. So that was his message. Market jumped up about 25, almost 30%. This has been really ugly now. So ever since we pulled back in the first correction in early 2018, then he announced his tariffs here. This was a mess. Market did take out a higher high, so that's a positive. and then the market took out a lower low, and that's a major negative. Now this piece right here was caused from the Fed. This was not from Trump or from policy. It was mostly from the Fed saying they were on an autopilot and they wanted to keep on raising interest rates. So they pretty much went about face after this sell-off. Market rebound, went back up to the highs, and then we just took out a higher high. Now we're back below. So it's still telling us that we can go higher. And sure, we could go higher. We just had the most recent 5-6% pullback from the most recent tariffs, and we'll see where we go. And so we just watch these levels. So right now, 29.47 is a main level here. 28.72 represents this January high. Let me actually zoom in. And so this is the SPX. This is the 13-day EMA, exponential moving average. This is the 50-day EMA. This is the 200-day SMA. I show a level down here of 25.83. So that could be a low that we'll test one of these days. And if we break below this level, then that's a whole different ballgame, because the Fed has went about face, and the Fed is now dovish versus hawkish. So now we're trying to figure out where we're going from here. Are we going to be breaking back above 29.45, which we could? And then if we do, we're going to hit resistance up here at 30.26 for a while. Or do we stay down here in the trading range? And if we keep on failing here at the 50-day line and at 29.45, then we're going to head back down to 28.72, or we could retest 28.15, possibly near the 200-day line. Here's a NASDAQ composite. Looks very similar. We broke out, back below it. Same lines, 13-day EMA, 50-day EMA, 200-day SMA. And we'll figure out where we need to go. Right now we're banging up against the 50-day line, which is pretty typical. This is the NYSE composite. It has about 20, I think it has like 2,400 stocks in it. And this is a really ugly chart. What I don't like about it is lower lows, and it's a lower low and a lower high downward sloping channel, and we're back down in this channel. Basically tells us that the stock market has been doing nothing for 18 months, and this chart has been in bearish mode for 18 months. And we did break above, so that was invalidating this chart. And so that was nice to see, but then just recently we're back down in this channel. So we have to give this another week or two to see if we can get back out of this channel and get back up here near this 13,246. We really need to get back. We need to get above this line to validate a bullish uptrend. Here's the small caps, and this is neutral to bearish. The small caps have not been participating. This is IWM. It tracks the iShare, it tracks the Russell 2000 small cap index. You can see that we're in a downward sloping 200-day line. We're stuck in this channel. Small caps need to start perking up, and they need to participate, and they're not right now. So until this breaks above 160, it's not going to give us an all clear signal on the stock market. Okay. This chart is really ugly. So this is the 10-year yield, and we're down to 1.73% interest rate on the 10-year Treasury, and it's rolled over really hard. What it tells us is that money has been flowing into bonds, into a safe haven trade, and some of that money was fleeing stocks. So this is the bond market. This is classified as the smart money. It's telling us that this economy is most likely going to slow over the next 6 to 9 months. That's what the bond market's telling us. Okay, so what's the best strategy with these volatile charts? So stock picking can still work. There's always something going up. It takes a lot of experience, time, and you need to modify your time frame. You just can't hold on to anything terribly long these days. I mean, boy, if you can get a 10% gain on a stock, sometimes you just want to book it and take it and move on. You should follow strict exit rules. That's our philosophy. Don't let anything draw down much more than, I mean, absolutely no more than 10%. If you can hold on to 90% of your money and you got a stock that just tanks on you, then take your 10% loss and move on. You can easily get chopped up in this market. Non-directional option selling strategy should work for the second half of 2019. So that's what I'm going to talk about for the Pinnacle strategy. So Pinnacle is a non-directional, income-generating, conservative, all-weather strategy. It's optimized for a new political era we're in. So stocks can sell off at any time. So this is key. It took me a while to wrap my arms around this. I had to spend a good year, feeling the volatility coming out of the White House, coming out of DC, and finally nailed it and finally got my arms wrapped around it, where we had to really reduce our allocation levels to play at a lot safer level with this market. And we're going to have to continue to be in this mode for a while. So I'm calling it the new political era. So capital preservation and safety are a top priority. We hold a maximum of 3 positions, so we're at about 30% allocation. That provides us plenty of cash to maneuver through periods of high volatility, and that's the key. So, once in a while we might touch 40 to 50% allocation, because if we're moving trades and adjusting trades due to high volatility, but then we'll get back down to 30% at steady state. And that's the best way to trade this strategy in this new political era. So I've been doing this for 15 years with this particular strategy, and I feel pretty comfortable that this is what we need to do. So the Fed is lowering rates now. It's good. Puts a floor under the market. It lowers overall volatility in general, which is good. There's a low probability that the SPX is going to break back above 30.26 for many months. So I like that. I like the market to be in a trading range. Strategy can generate 2.5 to 5% per month as the market trades sideways, choppy, and range bound. So we can handle that type of market. So this strategy is conservative by construction. So it allows us to sleep well at night, but we're still able to generate solid monthly gains. So we have plenty of cash in order to adjust trades and maneuver through bouts of high volatility. And it generates cash flow for people who desire monthly cash flow. So Pinnacle is up 20.3% year to date, and that includes commissions. This is just a screenshot off of the website, upsideoptions.net. Shows the returns for 2019. And recently we've been kind of in the 4 to 5% range per month. I can't promise that every month. Just depends on what the market does, depends on what Trump does, depends on which tweets he sends out, depends on how much movement we get in the markets. You can usually navigate through it because we have low allocation, and we can get through it because we're at low allocation levels. So if you keep on knocking out 3 to 5% months, this adds up pretty fast. So that's where we're at right now for Pinnacle. Okay, let's dig into a trade, and I'll show what the option trade looks like, and I'll show the risk-reward graph of the trade. Okay. So one trade we just did was an iron Condor, and I'm going to start with the put spread, and I'll show you what a put spread looks like on the risk-reward graph. So we sold the August 23, 28.50 put, and that's about 2 weeks out. So I like 2 week in duration trades for credit spreads and iron Condors. 2 week in duration. I'm using weeklies. I don't use the monthlies anymore. So I've been doing this a long time and used the monthlies for many, many years, and they started getting dangerous. And after a while, we just figured out that we couldn't even use the monthlies. Just too many algos out there, taking our trades out. And that took a long time to kind of figure out how to get around that. And because things change. Every year or two, things change. And the algos change things. So we moved to weeklies, and the 2 week in duration seemed to be pretty nice and work. So the August 23rd, 28.50 put. So here's the chart of the SPX, and let's look at our levels. So we care about these levels. So 28.15 is a level that is represented by these resistance levels here, some congestion and higher volume move here, price action there. So 28.15 and also represents kind of in this range near this low and the 200-day line. We have a 28.72 that represents this January 2018 high. We have a 29.45 that represents this breakout here. So this is the levels that we're in right now. Right now we're stuck under 29.45, and we'll see how long we stay stuck. The market always wants to go somewhere, and it always wants to kind of peg and max out. Either it, bangs up against 29.45 and the 50-day line like it's doing, and then if it can't get through it, it'll drop right back down to 28.72 and retest to 28.72, and then if it fails below that, it's going to come down and retest 28.15. So everything is pretty violent these days, and I think most of it has to do with the algos. There's just way too much money and very, very large firms with a lot of money behind them, and it's mostly algorithmic driven, probably half of the money, and it just kind of creates these extreme moves. So that's different in the last 3, 4, 5 years. It feels different. So right now we're up against 29.45, and then I wouldn't be surprised if we fail up against this 50-day line a few more times. Here's the 50-day line right here, and it has to also represents this high. We fail up here a couple more days, we're going to be right back down here. So it's going to be another extreme move, and then it's going to be another extreme move right back up, and then one of these days it's going to blast right up through and probably go right up to 30.26 and then start banging up against this resistance level. So you have to be prepared for these moves. So we sold the August 23rd, that's 2 weeks out, 28.50 put. So we're down in this range down here. Here's 28.50. All right, so I want to be at least below 28.72. Then we bought the 28.40 put for protection, so that creates a spread. 28.50, 28.40, bull put spread. So it looks like this, SPX, AUG 23, that's when it expires, 28.50, 28.40, bull put spread. Bull means we want the index to stay above the short put that we sold. And then puts, because we're using puts, and it's a spread. This is a 10-point wide spread. 10 points between the sell leg and the buy leg, meaning the broker holds $1,000 of maintenance to open up the trade. We bring in a credit for this trade of about $1.25. Sometimes I'll bring in $1.40 in that range, sometimes $1.50, meaning, at least the example here I'm showing, $125 came in. This is quantity one. You use $1,000 in your account. Let's assume this is a $10,000 account, so I'm opening quantity one, so 10% of the money is being used for a $10,000 account. We bring in $110 of premium after commissions. So that's about a 1.1% return for a $10,000 account. What we do is we open these up twice monthly, and I'm using the example, I'm opening up quantity two. So I'll go up to 20% allocation, and I do it twice monthly. So really I do it 4 times. 4 times $110 is $440. So the return for a 10K portfolio is about 4.4%. And I'm just actually getting started. I can make a lot more here, but actually I keep it conservative purposely. We're in a new political era, and we have to keep these allocations low, around 20 to 30%, because this market can move at any time. So I just opened up the put spread, but I'm going to open up a call spread too, and I can bring in about the same premium for the call spread, and that creates the iron condor. But just opening up the put spread, let's say someone says, I don't want any calls. I think this is going to blast higher, and I want to make sure my calls are way up here. So I'm not going to open them until I can get above 3,000. And that could be an argument. I would understand that argument, and some would agree with it. So you open up the put spread, the 28.50-40 put spread, and then you do it twice monthly. So in 1 month, you can bring in about $440. That's about a 4.4% return on a 10K portfolio. So again, I'm showing this for a 20% allocation. And then if the trade gets hit and it starts getting under pressure and this thing drops down into our 28.50 short put, then we'll make adjustments. And we can move the trade. And in general, I keep the adjustments pretty simple. I'll push it down 10 or 20 points, push it out a week. And I just want to make sure, my goal now, if I'm at 28.50, I want to kind of get down here below 28.15. That's where I'm going to be forced to push this put down to this level if I start getting under pressure. And then if I'm even more under pressure, I got to push that put down to below the 200-day line. And we can usually do these adjustments pretty cheaply. Okay, let's look at the risk-reward graph of what this option looks like. Okay, I see some questions coming in. I will answer these in a few minutes. All right, the risk-reward graph for this put spread is, start with half of it. Half of it shows the underlying SPX index on the left side. So here's, this is 90 days worth, so this is April through July of 2019. Here's the price of the SPX. Here's the SPX right here. Okay, moving. And this blue line represents the closing value of the SPX when I actually created this trade. This was on August 8th, so this was just a couple days ago. And the SPX closed at 29.38. Okay, so this is the left side of the risk-reward graph. This is standard deviations, 1 standard deviation and 2 standard deviations. These colored as purple and kind of pink, but I'm not going to get into that for this presentation. Okay, on the right side is the risk-reward graph for the trade. Down here is profit and loss for the trade. Anything to the right of this line is a profit for the trade. Anything to the left is a loss for the trade. And the risk of this trade is the $1,000 being held by the broker, $1,000, minus that premium we brought in. We brought in about $125 of premium. So that shows the maximum risk of the trade. And the maximum reward of the trade is this black line. This black line represents the trade at expiration. And that's really what we care about, at expiration. And that represents the premium that we brought in. We brought in $125 for quantity 1, and that's what this line represents. So here's the index over here, and as this index moves, this blue line will be moving up and down where it closes each day. And we want to make sure that this index stays above this point here. This represents the short put that we sold. We sold the August 23, that's 2 weeks out, expiration, 28.50 put. And that's the put that we sold, and that is where we want the index to stay above. Okay, so we want the index to stay above 28.50. And then here's the 28.40 put that we bought for protection, which creates a bull put spread. That's the shape of this chart here. And these lines represent the value of your option as time progresses. So as time, this is a 2-week trade, so as the 2 weeks starts clicking down day by day by day, you'll be on one of these lines here. But mainly what we care about is what it looks like at expiration. Okay, let's look at the bear call spread. So here's the same chart on the left. Here's time, 90 days, April through present for the SPX. Here's the SPX value. Here's the SPX chart. It closed at 29.38 on August 8th. And then let's go ahead and put the risk-reward graph up for the bear call spread. So I haven't showed this yet. So the bear call spread is I'm selling the 3,020, 3,030 bear call spread. So I sell the 3,020 call. That's represented by this point here. And then I buy the 3,030 call for protection. Creates a 10-point wide spread. Maximum gain is anything to the right of this line over here. That's about let's say $90 worth of premium. Sometimes for the calls, I'll bring in less premium, like $90, $80, or 80 cents, 90 cents, maybe up to $1. Just depends on what the market's doing. And I just want this index, the SPX index, where it's closed right here at 29.38. I want it to stay below this short call at 30.20. Maximum risk is the $1,000 that's being held by the broker minus the premium that was brought in. So about $850, $880, let's say. Now, when we combine the two together, you end up getting an iron condor. And what's nice about an iron condor is that only $1,000 of maintenance is being held by the broker. So you can open up both the top bear call spread and the bottom bull put spread, and they're only holding $1,000 because the market can't be in both places at the same time at expiration. Either it's going to be up here putting this top spread under pressure, or it's going to be down here putting this bottom put spread under pressure. So only $1,000 of maintenance is being held. So we opened up the August 23rd, 28.50, 40 bull put spread. So that's this part down here. And here's the 28.50 put point that we care about. We care about the short put that we wrote. Plus, we added the August 23rd 30.20 call that we sold here, so that's that point. We get an iron condor, and that's what this is. So we just want this index to stay below this point, the short call, and we want the index to stay above the short put. Here's the premium that we brought in for this trade after commissions, about $200. And if you do it 4 times, that's about 800 bucks. You do it twice monthly, and you do quantity too. That's about an 8% return for the month. I don't push it this hard. I usually try to keep this more in the 5% range, 4% range. It might touch 6%. I'm purposely keeping it under allocated for this new political era that we're in, and it's the right thing to do. You just don't want to get in trouble with these, and when you do, I mean, we have to adjust, and adjustments is part of the business. I mean, so I have a lot of experience in moving trades. I can move trades all day long, and it creates a lot of work and uncertainty, and then sometimes you might get up to 40 or 50% allocated while you're adjusting trades. So I just don't want to get any higher than 50% allocated while I'm adjusting trades. And I don't want to have to adjust trades. It'd be nice for a trade I can just open it and let the thing expire. It makes it easy. All right, so I'm showing for an 8% return here for the month at a 20% allocation. Okay, so while I'm in this risk-reward graph, let me see if we had some questions about risk-reward graph here. Let's see. So I see some questions. Do you trade these? This is Ray. He's asking, do you trade these with long puts? No. Well, the only long is the part that actually creates the spread. So this strategy is a credit spread, a credit strategy. And when you're a credit strategy, you are primarily selling the option as the primary thing that you're doing. And what you care about is selling the option because you're on the hook for it. So when I'm selling a call, I want to make sure that I'm going to be above certain resistance levels. And let's actually go up to, here's this chart again here. The main thing I'm looking at is after I do quite a bit of robust analysis over the weekend, I'm just trying to figure out, all right, where's this market going over the next 2 or 3 weeks? 1 to 3 weeks. And then support and resistance is very important here. And I want to make sure that if I'm writing calls, I want to kind of be up here in this range. And I'm okay in opening something below 3,000, like 29.90, because I can bring in a nice chunky premium. And I'm an expert at moving trades. I feel very comfortable in moving those trades and adjusting those trades. And I know that the market's going to go bang up against 3,000 for a while and probably pull back. And I can still get out of that trade, and I can bring in a nice premium. You also have to be patient. You have to be very patient. I think a couple of the other presenters in the past, Anka mentioned this: patience, patience, patience. You have to be patient and wait for the proper opportunity where all of a sudden you have a strong update, for example, and take advantage of that strong update, especially if you can get a position, you can get a short call, for example, above 30.20, for example. Boy, I mean, if you have a super strong update and you can get above 30.20, write that call, sell that call at 30.20, buy the 30.30, so that's a 30.20, 30.30 bear call spread. That's a beautiful trade. The probabilities of that index continuing to go higher and going right up into 30.20 in the next week and a half is low, very low. Periodically, they'll get hit. Then you have to move it up and push it out. And then if you get a breakout, that 30.20, all of a sudden the market just breaks out and starts blasting higher. I call those flips. You want to take that call and flip it to a put spread. You want to get on the right side of the market. And you do not want to have to keep on pushing a call spread up, up, up every week, because you got to roll these every week, usually. So that takes a lot of experience. And so, just opening up iron condors and credit spreads, I can put a chimpanzee in a room and they can open up iron condors and credit spreads. And sometimes you could be successful for 2 or 3 months, 4 months, and start feeling really smart. And then then your face will get ripped off. The market will just hit you hard, and you'll give all that back, and you'll give back some of your principal. So that's where you have to have the experience in adjusting the trades. So just kind of keep that in mind. It just takes experience in knowing how to move the trades and adjust the trades, because 6 months out of the year, 7, maybe 8 months out of the year, you're not doing many adjustments, but 4 months out of the year, you're going to be adjusting a lot. And we just keep it simple. Keep it simple, and trade starts getting hit on the put, I'll move it down, push it out a week, move it down again, push it out a week. Now, that's as long as I believe we're not going into a recession. This gets a lot more difficult when the economic data starts rolling over. And just to show you kind of what a typical analysis looks like, this is off of the Upside Options website, so upsideoptions.net, and I show the weekly analysis. So I usually do this over the weekend, and this is the July 28th analysis. And usually the first, for people who don't have the time or interest of really digging in, just read the first 3 or 4 paragraphs, 5 paragraphs, just read the top section. And what I'm really doing is I'm trying to figure out, these 2 sentences right here, or paragraphs, is what I really care about. So on the risk potential to the upside, for example, I'm saying this market has been wanting to go higher, and the SPX recently took out a new high. The next intermediate term upside target on the SPX is 3060, with a pause and a possible quick pullback, and then climbing up to 3100. So that's what I saw back then on July 28. Now, to come to these conclusions, then on the risk to the downside, because of the Powell put, there's a high probability the SPX will stay above this level, 2945, over the next 30 days. So just to get to these 2 paragraphs, let me show you all the analysis I have to do. So I got to go through all the indexes. I got to go through all the macroeconomic data. Got to look at earnings, look at volatility, look at high yield bonds. I have to look at the yields. Here's probabilities of what the Fed's going to be doing. Here's the yield curve. I look at Europe, different charts of Europe, worldwide, emerging markets, China, Japan. I look at about 15 major ETFs, just all the different sectors, trying to figure out what the sectors are doing, because that gives me visibility into how the market's behaving. Breadth, these are cumulative advanced decline lines, and then the economic charts. So I look at all of that each week, and then that gives me an idea to be able to predict these 2 paragraphs on the risk to the upside and on the risk to the downside. I care about what the market's doing for the next week to 2 weeks to 3 weeks. That's why I keep on bringing up this chart, because this is the underlying that I primarily trade for this strategy. This is the Pinnacle strategy. This is a non-directional credit spread and iron condor strategy. And I care about these levels, and I care about probabilities of these levels. Okay, let me just get to another question. Is it worth the extra premium for the short call spread? Well, just depends from week to week to week. And, that's the call that you can make. And if you feel just comfortable with the put spread, just open up the put spread. If you want to bring in just a small premium and make sure you're up closer to 3,000, trying to get above that level, you got to make sure that you're patient enough and you wait for a nice update. So a nice update, boom, you can actually open up a 30, 3,000, 3,010. Now you're above a major level, a major round number. You can bring in 80 cents. Maybe you do it. You just have to be prepared and be experienced to move trades, because periodically you will have to move trades. Tony asks, what are the commissions for an iron condor? Typical brokers charge 70 cents, 65 cents a contract. So if you open up an iron condor, you're opening up 4 legs. $3 in commission, $2.50 to $3 in commission, plus usually a flat ticket charge of $5. So it might be $8 to open up the trade. That's a quantity 1. So you still have that flat rate. So that flat rate's usually about $4.95, $5, sometimes as low as $4, and then you're going to be paying about 65 cents per contract. If you open up just a put spread, for example, that's 2 legs. That's about $1.30 in commission, plus the ticket charge of $5. Okay. Ray asks, do I use stops? No, I don't use stops. So when a trade starts drawing down, so let's say I have a bear call spread and the market just starts rocketing, starts climbing into my bear call spread. Let's say I brought in $1 or $100 for quantity one. And then now it starts drawing, now it starts increasing in value. So now it's worth $2, meaning if I wanted to buy that back and get out of that trade, I have to spend $2. I just lost $1. So I brought in $100 a premium, hoping to keep that $100. Underlying starts climbing. Now that call spread's worth $2. So I have to buy it back for $2 or $200. So I lost $100 on it. That's if I want to close it. I prefer to adjust it. I call it doing acrobatics around the market. So I'd prefer to actually take that call spread, push it up out a week, spend $1 doing that, and then I'll open up a put spread, and I'll bring in $1 on the put spread. So I'm paying for that adjustment, but that's why I need cash. That's why I need to be able to maneuver in the account and have sufficient cash to maneuver if the market starts moving a lot. Let's see, someone asked about what was your put strike. So that was the put. I was showing her a 2850 put for this index, for the SPX. Okay, let me actually just talk a little more about this iron condor, then I'll come back to the questions. Okay, so we opened up the put here. Oh, okay, so we already got up through the risk-reward graph of the iron condor. So in this case, we're pretty much selling the 2850 put. We're selling the 3020 call. For delta on your short leg, it's usually about a 15 delta. That's kind of what I'm using. I used to use 10 deltas, but now I'm using shorter term trades. These are 2-week in duration, so I'm using more like a 15 delta, sometimes a 17 delta, sometimes a 13 delta, meaning 13% probability that leg will get hit. So there's still high probability trades, but you're not going to be right every single time. For my analysis, I'm usually right 73% of the time, so I'm wrong 27% of the time. And so we will have to make adjustments. Okay, so where's this market going next? Well, the market stabilized and quickly moved higher, and then now we're testing the 50-day EMA near 2835. Let me just bring up that chart right here. So we pretty much pulled back. This was the most recent Trump tweet, down 5-6%, getting very tired of this. And then now we pretty much had a really strong up day, went up to the 50-day line. I just don't know where we're going next. We could break up through 29.45. And if we do, then we're going back up to 3,000. We could go back up and test 30.26. Based on what the small caps are doing, they're not participating. Based on what the NYSE composite, I showed you those lower lows and lower highs. Also, the mid caps don't look that great. It tells me that the probabilities are higher that we won't break out, but or at least we won't be. I think that extremely low probabilities of us going any higher than 30.26. I just don't see us taking out any new highs. But could we get back up there and touch this level? Absolutely. And then could we fail right back down here and retest 28.15 or even really overshoot and touch the 200-day line? Sure, we could. So we're gonna have some violent moves in here as we're kind of consolidating. All right, so the China trade war grinds on. It will continue to slow U.S. and global growth, and I think we're more concerned about global growth. U.S. is still doing pretty well. So on the negative, earnings growth has slowed. However, earnings growth was really strong for 4 or 5 straight quarters. I mean, it was just off the chart strong, and that was mostly, some of that was from the tax cut. So having 2 or 3 quarters of flat earnings growth is not a disaster, and that's why the market's kind of blowing it off. Escalated trade war with China, that's a negative. Bond market is pointing to a slowing economy with a flat yield curve. And the 10-year yield is down to 1.65, 1.7%. So, I mean, that's the smart money, and it's telling us that this economy is going to slow. That's what the smart money is predicting, because money is pouring into bonds. On the positive, jobs growth and the strength of the consumer is strong. Interest rates and inflation are low. That's good for stocks. The Fed is ready to lower interest rates again if needed. So they're dovish again, and that will put a floor into the market. That's why, when you're looking at that chart of the SPX, the S&P 500 index, pretty high probability we're going to be staying above those major support levels I've been showing, especially above the 200-day line. We have the Powell put. That puts a floor into the market. That's pretty much basically the Fed. So the SPX will probably trade range bound between 28.72 and 30.26 for many months. And this is an optimal market to write credit spreads and iron condors. You just need to kind of know what you're doing, and you have to know how to move trades. So I predicted, what I just said was I believe we're going to be staying between 28.72, and I guess what I'm saying is we're probably going to be back up here. And we could. Now it might take a week to get up there. Just don't know. Okay, so let's go. Let me just see what other questions we have. All right. Tony asks, do you do any day trading options? No day trading. So everything that, we're more swing traders. We had one strategy from one trader that worked with me, but he had to leave the company. He went, he needed to go do something else. But he was doing pretty well, and he was doing shorter term options trading, buying calls, buying puts on stocks. But there's no free lunch. If you want to just buy a stock, you're shooting for 10-15% gains. If you're really lucky and the thing runs and keeps you in, you might get 20-30% gain on a stock. And then you can usually keep your losses under 5%. If you're buying a call, now you're shooting for 50 to 100% gains, but then when the stop's out on you, your loss is going to be about 40 to 50% on the stock, on that put. I'm sorry, on that option, if you're buying an option on a stock. So you can do options. It's just, it takes more concentration, and it moves, the value of that option moves quite fast, and sometimes you get stuck in it. It's hard to get out. Sometimes the bid-ask gets kind of wide, and if your position's too big, the algos will notice you and they'll try to take you out. And you're trying to get out of a trade, and here you didn't book as much of a profit as you thought you could, for example, or the loss was larger than you thought. You're hoping to keep the loss under 35% or 40%, and it turned into a 55% loss before you can get out of that. So options are a little tougher to trade on stocks, but they're doable. Let's see. I think I covered a lot of these. What action do you take to defend your position? So as I said, we roll trades quite a bit. I will, if the put spread starts getting under pressure, I will roll it down and I'll push it out a week. And when I say I roll it down, I'm usually rolling it down 10 points, maybe 15 points. And then now that costs money, and so you need to pay for it. So how do you pay for it? Well, you need to open up a call spread. You could, that's one thing. So you complete the iron condor on it. Or you use more cash and you open up another put spread, but much lower, kind of in a new location, because if the market's falling, you can open up a put spread that's much lower, bring in $1, bring in 80 cents, and that pays for the adjustment. But now you just went from 30% allocated up to 40% allocated. Okay, so that's why you want to start at 30% allocation in this new market, this new political era. In the past, I used to run at 60 to 70% allocated for many years, and things have changed. And that's one question here is like, have Trump's tweets, has technical analysis become more difficult? Yes, it's this market has become more difficult to navigate. And I think it has to do with the algos also. So the algos are moving the market in more extreme ways. And then we have tweets coming out right in the middle of the day. And it's, and we're also high. I mean, the market's trading at 17 and a half times earnings. It's not cheap. It's somewhat priced for perfection. and it has become more difficult. With regards to probabilities and standard deviations, sure, I'll watch standard deviations. I'll watch for, kind of where that index could trade over the next 30 days. But I care more about support and resistance and major, major moving averages and things like that. So I care more about that. So just use the technicals, use support, use resistance, use pockets of high volume. You'll see congestion areas that had a lot of high volume, and those will tend to be a resistance or a support level, and will usually work, and especially if you just have a 2-week trade. So these trades are just 2-week in duration. 10 trading days goes by pretty quickly, and then before you know it, you're out, and then you open up the new one. And then if you're adjusting a trade, then so be it, and you might have to adjust it for a week or 2 or 3. Now, be careful on the put spreads, and if we start seeing economic data rolling over and deeper and deeper and deeper, that's why I watch a lot of stuff. That's why I would look at 50 charts in that analysis each week, because I really care about what's going on around the world, around Europe, what's going on with China. Care about the health of investor sentiment, of course. Breadth is a good indicator. Cumulative advanced decline is a pretty good leading indicator, giving you an idea if you're starting to see deterioration. If I'm seeing an advanced decline line rolling over and deteriorating gradually, I will start getting more and more cautious on the puts. So I'll have less exposure on the puts, and I'll start overweighting on the calls. And I'll tell you, 6 months ago, I only wanted to write calls. Everything I saw was negative, 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 and it was just telling me that I want to write calls, I want to avoid the puts. And then once the Fed changed course, and that was pretty much right after December 24th, the market just tanked, and then early January, he started going more dovish. That changed everything. So never fight the Fed, as they always say. And since that changed everything, I'm like, okay, I can start writing puts again. But until the Fed changed direction and said they're going to start lowering interest rates, or were considering lowering interest rates, I was being extremely cautious on the puts. Okay. John had a question about if the probability of delta is high, why not go naked? Sure. But that's a different strategy. So if you want to open up a naked put, you can. Just be prepared. You have to have cash to buy that stock. I do not recommend doing that on portfolio margining. I recommend that you have the cash to buy that stock if that stock is put to you, and that's a different strategy. So these are credit spreads. So every call or put that we sell is protected by a long call or put. So it's a 10 wide credit spread, and that's purely what we do. Let's see, got a few more questions coming, and I have 3 more minutes here. Let's see. Do I do options on futures? No, I don't. Purely just options on, at least for this strategy, I just focus on, usually, I did do the RUT for a long time, and then the powers to be changed the way it worked at the exchanges, where only 2 exchanges were trading the RUT, and it was just a foolish decision in my mind, and there wasn't enough competition to actually get the trades that I needed. I probably will go back to start trading the RUT, but I haven't done it in a while. I've been pretty much using the SPX. Okay, everyone will get links to these presentations. Divergence indicators, yeah, divergence is actually really powerful. That's probably one of the few ways to really get a good reading on indicators, for relative strength or stochastics or MACD. Watch for divergence. And if you see a stock climbing, but you see a MACD taking out a lower high, that's very powerful. And that's one of the few reliable ways of using an indicator, is using divergence. So if you're not sure what I'm talking about, just go into Google and type in, MACD divergence. What does that mean? Or go to stockcharts.com they have a good learning center, and type in divergence of indicators. And I would spend an hour on that, watching, 2 or 3 indicators like a relative strength or a CCI, commodity channel index indicator. And if you start seeing divergence, that's usually pretty powerful. Arnold asks, does the IWM offer greater reward to risk? Not necessarily. They're all about the same. The IWM is an ETF, and I recommend doing 2-point wide spreads. So I've done all the analysis on that. I wrote a case study around that. I don't think I have it up on the web anymore, but it was a pretty long case study where I did all different widths of spreads. What I like about 10-point wide spreads is the commissions are lower. The minute you do an ETF, it's recommended to do 2-point wide spreads, and then the commissions will be higher. But you're stuck. You got to do a 2-point. You could do a 3-point. You can do a 2-point or a 3-point wide spread, but that's what I would focus on for the ETFs. IWM is an ETF. Now you can use the RUT. RUT is the index, and you can do a 10 wide on the index. You can do 5 wide spreads also, and I do them. It just changes the risk reward a little bit. You just have more commissions, and I think from my analysis, doing 10 wides, the commissions were, the overall returns were just a little better, but it's all about the same. You can do 5 wides also. Okay, when do you exit a trade? Well, I exit a trade when I can get out of it. Purely, simple as that. You want the trade to expire out of the money. So let's use an example. Let's say I write the 30-20, 30-30 bear call spread, and the market rockets. It just takes off. So I bring in $1 initially, and now the SPX just blasted right up through my 30-20. So I'll roll it a few times because the market's not going to go up forever. Usually for the calls, the market will not go up forever. But sooner or later, I'm going to have to call Uncle and just say, all right, I got to get on the correct side of this market because the market just keeps on grinding higher. So I'll take that call spread, I'll move it up 10, push it out a week. If it gets hit again, move it up 10, push it out a week. But what I'm doing is I'm opening up a put spread underneath that, by the way, to pay for that adjustment. So I keep it up. So I have an iron condor and it's going up, and I'm pushing it up, pushing it up. Sooner or later, I might take that call spread and flip it to a put spread. Just turn it into a put spread and just try to get on the right side of the market. I got to get out of that trade. Once I'm out of the trade, then I get my full $1,000 back. You have to remember a 10-point wide is $1,000 is being held. And I initially brought in 100, so let's say $900 was at risk. That's how much is at risk. I need to get out of that trade. I need it to expire out of the money. That short call needs to expire out of the money, and I will keep on adjusting it until I'm finally out of it. And sometimes you get stuck in trades a long time. Back in 2008, I was rolling trades for 6 months, and I ended up getting 70% of my money back, maybe a little less, 65% of my money back. Ended up taking about a 40% loss. I think it was 35% loss, but at least I got most of my money back. But I had to be patient, and I had to keep on adjusting. And now that was 2008, and I was not doing nearly the analysis I do now. And that's what changed everything. After I got hit in 2008, I'm like, oh my gosh, I need to look at so many more things, because my exposure back in 2008 would have been half, even probably a quarter. Following everything I follow now, I would have been at much lower exposure levels back in 2008. I still would have got hit, and I would have had some losses, but nothing too major, because I would have been watching many, many more things. Okay, I'm going to have to run. I've already gone over 2 minutes here. And if you have any other questions, send them to support@upsideoptions.net. Here's the contact information. And you can sign up. We have a free, here's the weekly market update. So that's on the website, upsideoptions.net. And if you're in the market, and if you do anything in the market, I recommend just to take a look at the analysis that I do each week and just read the first 5 paragraphs. You don't have to dig into all of the charts. And the first 5 paragraphs, I'm right about 73% of the time of what's this market going to do next over the next 2 to 4 weeks. And then you can get free trials also on the website, upsideoptions.net/free-trial. Okay, thank you very much for your time, and let's move on to the next presenter.